90% of traders fail. Let that truly sink in. 9 out of 10 people who open an account, dreaming of hitting it big and trading their 9 to 5 for financial freedom, end up failing. They don't just lose, they blow up. Accounts are wiped clean, confidence is shattered, and dreams are reduced to dust. Is the market to blame? Is it the brokers, the economy, or some secret algorithm? No, it is you. It is your fear, your greed, and your ego. It is the lie you tell yourself every time you click buy without a plan. Every time you chase a green candle like a gambler hunting their next high, you are making a fatal mistake. Right now, someone somewhere is repeating the exact same error you are about to make. They are staring at the screen, over-leveraged and overconfident, hoping and praying, just one trade away from total disaster. Trading is not a game. It is not a shortcut. It is not the overnight millionaire magic you see on TikTok. This is the brutal reality. 90% of traders fail. But what if you didn't have to be one of them? Why do they fail? And how do you join the 10%? Stay with us. We are about to expose every mistake, every trap, and every lie that losing traders tell themselves. We will show you how an average guy named Danny broke through the cycle. This isn't just about the markets, it's about mastering your own mind. The rise of the amateur meet Danny, 24 years old. He's fresh out of college. No, not with a finance degree. He has zero trading experience but ambition that reaches the stratosphere. Danny has just discovered the world of trading. Like millions before him, he believes he has found the ultimate secret to wealth. He's watched the gurus and followed the signals. He has TradingView spread across 3 monitors, Discord on another, and pure caffeine pumping through his veins. His initial deposit is $1,000. In just 5 trades, he miraculously turns it into $3,000. Just like that, he's hooked. He's convinced he's cracked the code. To him, 3 consecutive wins aren't luck. They are proof of his grind. He's already planning to quit the 9 to 5 life he hasn't even started yet. But here's what Danny doesn't realize. Early wins are the most dangerous poison. Nothing warps the human brain like easy money. This is where the real enemies emerge, not in the news or the charts, but inside his own head. The voices in the head. Greedy Greg whispers in his ear, "Double it, triple it. You're unstoppable, bro." Meanwhile, fearful Fiona shouts, "Take the profit now. What if it reverses?" Every green candle provides a dopamine rush. Every pullback feels like the apocalypse. Danny is no longer trading the chart, he is trading his emotions. He begins revenge trading and ignoring his stop losses. He enters positions out of sheer boredom. He over-leverages, overtrades, and underthinks. Yet he tells himself it's fine because he feels like a winner. That feeling is the trap. He tries a new strategy, adds a new indicator, or follows a new guru with a rented Lamborghini. What Danny fails to see is that he is not in control. The charts have become his mood swings. His confidence fluctuates with every tick of the RSI. He isn't a trader, he's a puppet, and the market is pulling every single string. But he won't stop. He still believes the next trade will fix everything, that this is just part of the process. He believes he is the exception. The death spiral. The screen flickers red, then a deeper red. The market is moving, but not in his favor. Danny hesitates, then clicks, then panics. The spiral begins. In just 2 trades, he gives back half his account. After 3 more, he is below his starting balance. The $3,000 peak he bragged about is gone. But this isn't just a financial loss. It's an identity crisis. Danny doesn't see red on a chart. He sees an attack on his self-worth. This is when the most dangerous version of a trader is born. The revenge trader. There is no analysis or logic left. Only raw desperation disguised as strategy. He doubles his position size, adds to losing trades, and gets short-squeezed by his own ego. Every loss is met with more frantic activity. Welcome to the death spiral, the point where thinking stops and survival instincts take over. Danny still believes he is just one perfect entry away from turning it all around. This is the delusion that destroys dreams. The gambler's fallacy wrapped in a trading terminal. The illusion of complexity. Danny is no longer in the market. He is on a mental roller coaster with no safety bar. He's crashing through FOMO falls and whiplashing through panic peaks. Just when he thinks he's stabilized, he hits the overconfidence overpass, and the cycle repeats. He tries a new strategy called hope, which is 100% backtested in fantasy land. He piles on RSI, Bollinger Bands, and Fibonacci lines until the chart looks like a spaghetti sauce explosion. More lines do not equal better trades. More indicators do not build discipline. Danny doesn't need a new tool, he needs a new brain. Instead of looking inward, he blames the market, the news, the broker, and manipulation. He blames everything except himself. This was supposed to be freedom, but all he has found is anxiety, isolation, and loss. The dopamine has evaporated. The thrill has faded. Now, there's only the crushing weight of the truth. He doesn't know how to win. He only knows how to react. The turning point. Transformation. Hitting rock bottom is often where the real lesson begins. It's quiet now. No alerts, no noise. Danny's account is nearly empty and his confidence is obliterated, but the illusion has finally vanished. This is the part they don't show you. The shame and the 1,000-yard stare. You realize you weren't trading the market. You were trading your identity. Now you face one question. Do you quit or do you transform? Enter Coach Pips, a guide who isn't there, to teach Danny how to win, but why he lost. He doesn't sell signals or chase breakouts. He teaches Danny how to sit in silence. He teaches him to breathe when nothing is moving and to stay focused when everything is screaming. The first lesson, mindset over markets. Discipline isn't built during a trade, it's built in the hours when you aren't trading at all. Coach Pips introduces a new kind of chart, one made of habits. No entries or exits, just a graph measuring how often Danny follows his own rules. Building the professional, Danny begins to journal and review. He learns to detach his self-worth from the outcome of a trade. He stops asking, did I win, and starts asking, did I follow my plan? He tracks his emotions like price points, labeling his thoughts the way he used to label resistance zones. He learns to spot the internal patterns before they ever appear on the screen. The new mantra is, risk small, think big, grow slow. He stops trying to predict and starts learning to respond. The gambler chasing candles is gone. A strategist is emerging, calculated, calm, and in control. He sharpens his mind before he ever touches the mouse. Slowly, the chaos turns into clarity. Greedy Greg and fearful Fiona still whisper, but Danny no longer reacts. Emotions have become data, not directions. He enters with intention and accepts uncertainty. He wins by not needing to win. He is no longer his own worst enemy. The real edge. It's a new day. There's no drama or panic, only peace. Danny sits quietly with a single clean chart on the screen. No noise, no indicators. His strategy is simple and his mission is crystal clear. This is a transformed human being. He understands that the real edge in trading isn't the setup, it is the self. He isn't here to beat the market. He is here to outlast it. Success is about doing the right things every day, especially when no one is watching. Here is what he now knows. Stick to the plan. Discipline beats excitement. Control your emotions. Calm minds make clear decisions. Risk small. Long-term wealth is built through survival. Review everything. Data reveals the truth. Ego hides it. The ultimate paradox. The more Danny trades like a machine, the more he becomes human again. Trading isn't about getting rich overnight. It's about becoming the kind of person who can actually handle wealth when it arrives. If you want freedom, earn it through structure. If you want consistency, build habits that won't break under pressure. If you want to be in the top 10%, you must stop thinking like the 90%. Danny isn't rich yet, but he isn't broke anymore. Not mentally, emotionally, or strategically. He has clarity. He doesn't scream at charts or pray to price action. He shows up, follows the process, and grows relentlessly. The path to success isn't flashy. It's quiet, intentional, and to some, boring. But it is profitable for those who endure. Ask yourself, are you trading to feel alive, or are you trading to build a life? The market doesn't care about your dreams, but it will reward your discipline. Like Danny, you can start a new story. One rule and one mindset shift at a time. You've seen why the 90% fail. Now decide, will you stay among them, or will you become the 10%? I just recently finalized a trade that secured a massive 10% gain, bringing in a significant profit that has bolstered my portfolio tremendously. You might wonder how I anticipated this upward move. It was all thanks to identifying this specific candlestick pattern right here. In this video, I'm going to reveal my favorite candlestick patterns. the very ones I rely on daily to interpret charts and predict market direction. By mastering these, you can become a far more successful trader and execute high-profit plays just like the one I just finished. Let's dive straight into the details. The engulfing candle. One of my absolute favorite and most frequently used patterns is the engulfing candle. I've featured it in many of my tutorials because it is incredibly potent. This specific candle is so strong because it can pinpoint the exact moment a price reversal is likely to begin. But what exactly is an engulfing candlestick? The name essentially explains the concept. It is a candle in the opposite color of the previous one that physically engulfs it. A bullish engulfing candle opens at or below the previous candle's close and finishes above its open. Essentially, it is larger than the preceding candle on both ends, making it appear as though it has swallowed the previous price action. Trading the engulfing pattern. Let's look at an example. Here we've identified a very strong support level where price has bounced multiple times, proving the market respects this zone. As price returns to this support, we might expect another bounce, but we need more than an assumption before entering a trade. That is when we spot a bullish engulfing candle. It completely covers the previous red candle right at the support line. This is an intensely bullish signal, giving us the confidence that the price is headed upward. We enter the trade, and as you can see, the move follows through perfectly. A word of caution. It is vital to remember that just because you see an engulfing candle, bullish or bearish, it doesn't guarantee a reversal every single time. You should never trade based solely on a single candlestick pattern. Instead, treat these patterns as hints or clues about the market's next move, rather than absolute decision makers. Always combine these patterns with other technical tools, such as support and resistance levels, indicators, and broader trading strategies. To be clear, a pattern indicates a high probability of a move in a certain direction, but it is not a 100% certainty. The bearish engulfing. Now, let's examine a bearish engulfing example. We have a similar setup, a strong resistance level that the price has respected multiple times in the past. As the price climbs back to this level, it begins to lose steam, and a bearish engulfing candle forms, completely swallowing the previous green candle. This rejection at resistance, combined with the engulfing signal, serves as a fantastic indicator to open a short position. And look at the result. The price drops significantly. The momentum candle. Next, we have the momentum candle, which is much easier to identify than the engulfing pattern simply because of its sheer size. A momentum candle is a single bar that is 2 to 3 times larger than the candles immediately preceding it. This candle is exceptionally powerful because, once it appears, the price usually continues to trend in that direction, making it an excellent entry signal. The most effective way to utilize this pattern is within choppy or sideways markets where the price has been moving horizontally. Why momentum works. If you witness a sideways market followed by a massive momentum candle, 2 to 3 times the size of the previous ones, you can be fairly certain the price will continue that breakout. Think of it this way. In a sideways market, many short sellers are trapped in their positions, waiting for a direction. They often set their stop losses just above the resistance. When a sudden surge hits that liquidation zone, all those stop losses are triggered, acting as fuel that drives the price even higher. The same logic applies to shorts. If a huge red candle breaks out of a sideways range, it's a strong signal to go short as the downward move is likely to persist. Multiple candlestick wicks. Next up is the multiple candlestick pattern. This is one of my personal favorites because it tends to be very reliable and easy to spot. This pattern occurs when you see 3 or more consecutive candles with long wicks pointing in one direction. The more candles, the better. I prefer to pair this with key support and resistance levels. Look at this chart. What do you see? We have a key support level, and then we see multiple candles with downward wicks touching that exact line. Interpreting the wicks. These downward wicks tell us a story. Sellers are desperately trying to break the support, but buyers are fighting them off and winning every time. This repeated failure to break lower confirms the strength of the support and suggests a high probability of an upward bounce. Conversely, in a short example, if price reaches resistance and multiple candles show upward wicks, it indicates the market is unwilling to move higher. This provides a solid short entry. We enter the trade expecting a reversal, and the price falls exactly as anticipated. The doji candle. Next, we have the doji candle. A doji is characterized by a very thin body with wicks on both sides. Understanding this candle is crucial because it is a premier indicator of an impending price reversal. A doji represents total market uncertainty. The bulls and bears are in a stalemate, and the market is experiencing resistance to its current path. Whenever you see this kind of indecision, the price will more often than not begin heading in the opposite direction. Confirming the doji. Let's look at an example. The price is trending down sharply when a green doji appears. This tells us that sellers are losing their conviction and buyers are beginning to step in, marking a potential entry point. However, my personal rule with dojis is to wait for confirmation. I wait for 2 more candles of the same color to ensure the reversal is real. In this case, after the green doji, 2 more green candles move upward. That is my signal to enter, and the price takes off from there. Doji variations. There are several variations of the doji you should recognize. The regular doji is what we just discussed. The long-legged doji is similar, but features much larger wicks, showing even greater volatility. The dragonfly doji has a small body at the top with a long bottom wick, while the gravestone doji has a small body at the bottom with a long upper wick. Despite their different looks, they all tell the same story. A likely reversal in price is coming. The hammer and shooting star. The next candle we'll examine is the hammer. This candle features a decent-sized body at the top and a very long lower wick. This tells us that while sellers managed to push the price down significantly, buyers absorbed all that pressure and drove the price back up. This is an extremely bullish signal, suggesting the market will continue higher. Similarly, the shooting star is essentially an inverted hammer with a long upper wick. If you see a shooting star at the top of a move, it's a strong sign that the price is about to reverse downward. The tweezer pattern. The next pattern is known as the tweezer. This involves a red candle followed immediately by a green candle, both having nearly identical wicks at the bottom. If you spot this pair at a support level, it's a strong indication that an upward move is imminent. For example, as the price hits support, we see a red candle with a bottom wick, followed by a green candle with a matching wick. This proves the support is holding and momentum is shifting upward. For a bearish signal, you simply look for the opposite. 2 candles with matching wicks at the top, tweezer tops. The Marubozu candle. The final pattern I want to discuss is the Marubozu. A bullish Marubozu is a large green candle with absolutely no wicks, essentially a solid green rectangle. This is a great indicator that the price will continue in its current direction. You'll often find these in the middle of a trend, confirming that the move has plenty of strength left. In a Marubozu, the low is the open and the high is the close, meaning buyers maintain complete control from start to finish. The bearish Marubozu is the same concept but in red, signaling that sellers are in total command and the price is likely to keep falling. Bonus tip. Automation. As a thank you for watching until the end, here is a bonus tip. While you should try to memorize these patterns, I know it can be difficult to spot them in real time. Fortunately, there is a way to have your charts identify these patterns for you automatically. On TradingView, go to the Indicators tab and simply type the name of the pattern you want, such as bullish engulfing. Click it, and the platform will highlight exactly where that pattern occurs on your chart. You can even add multiple patterns at once, making them incredibly easy to spot without having to search too hard. Final thoughts. I hope you found immense value in this breakdown and learned something new. If you did, please take 5 seconds to like this video. The only real challenge with candlestick patterns is the false breakout, where a pattern forms, but the price does the exact opposite of what's expected. If you want to learn how to avoid those traps, watch my next video where I reveal my secret strategy for dodging false breakouts. Thanks for watching, and I'll see how I would master day trading if I could start over. This is exactly how I would learn to day trade if I were starting from scratch today. For some context, I have been trading for about 3 years, during which I've generated over 6 figures in profit. I originally went to college, earned my degree, and even started a real estate business. At the time, I was considering a career in the real estate industry, essentially following the typical matrix path. However, one day I decided to just say, forget it, and go all in on Forex trading. I realized I could earn far more through trading than a traditional job, so why bother working for someone else? I worked my tail off, spending 6 months learning everything there is to know about the markets. Since then, I've been mentoring private students, many of whom have transitioned into profitable, full-time traders themselves. If I had found a step-by-step guide like this when I began, I would have mastered Forex 10 times faster. There are 3 critical phases to this journey: the learning phase, the testing phase, and the execution phase. Phase 1. The learning phase. Don't reinvent the wheel. The first step is to learn from a single expert. There's no reason to reinvent the wheel or struggle to create your own strategy from scratch. If a method has proven successful for someone else, it will likely work for you too. This is why I strongly recommend finding a mentor. The secret to success is following someone who is already achieving the results you want, someone who truly understands the market, and trying to emulate their thought process. The internet and YouTube are filled with free information, which can become overwhelming because there are thousands of strategies scattered everywhere. It often feels messy, leaving you unsure of where to begin. I personally post new high-value trading videos every week for free, and many other talented YouTubers do the same. My advice is to pick one creator you resonate with and consume as much of their content as possible. I want you to dedicate one specific day a week, Saturday for example, entirely to your education. Spend that whole day watching tutorials, studying online courses, and reading free trading books. Immerse yourself in the data. Remember, no matter how skilled you become, you must remain a student. To this day, I am still constantly studying advanced strategies and deepening my understanding of trading psychology. Phase 2. Join a community and surround yourself with growth. The second step is to join a community. You've heard the cliche that you are the average of the 5 people you spend the most time with, and it's absolutely true. I've noticed that my inner circle consists of highly driven, goal-oriented individuals who know exactly what they want in life. If you want to be a successful trader, you must surround yourself with people on that same path. I run a Discord server called the Trading Tribe, where you can join for free and connect with like-minded individuals. Every member is either already successful or working tirelessly toward that goal. You can post your chart setups, ask questions, and observe other people's strategies to see what is working. There are so many helpful people in that server who are happy to assist you on your journey. You can click the link in the description to join us. Phase 3. The testing phase. Respect the process. The next phase is testing. You must trade on a demo account before ever touching a live account. Do not trade with real money until you are consistently profitable in a simulated environment. Do not rush this process. When I started, I was just like you. I hated my job and being broke, and I wanted an exit as fast as possible. I only spent 1 month on demo before jumping into a live account. I deposited $500 and blew the entire thing in just 2 days. If I were starting over, I would spend much more time on demo. Here is the secret. You must treat that demo account as if it were your own hard-earned money. Trade the same position sizes you would use in real life. Trick your mind into believing the stakes are real so you can experience the same emotions you'll face on a live stage. Please remember, only move to a live account once you have a proven strategy, completed thorough backtesting and front testing, mastered your emotions, and practiced proper risk management. Most importantly, you must be consistently profitable. Many new traders skip this and lose a significant amount of money they shouldn't have lost. Do not rush. Unfiltered advice for beginners. Here is my raw advice for those who want to learn fast. Step 1 on your to-do list is to accept that you will likely lose money. As a beginner, losses are almost guaranteed. You might as well save your capital and practice until you are confident, then switch to real money. Even then, start small, because you're going to face a steep learning curve. You've probably seen gurus living the dream, driving fast cars and living in mansions, and you might expect to become a millionaire after watching 3 videos. That isn't how it works. Like anything worthwhile in life, trading takes time to master, but the reward is worth the effort. In the beginning, forget about the profits. Focus entirely on learning, finding a winning strategy, testing it, and growing as a trader. The money is simply a byproduct of your improvement. Put in the work now and the market will reward you later. Phase 4. The execution phase. The final step is execution. Find a strategy that works and apply it to a live account. You can check out the video on my channel where I reveal my own back-tested strategy. Click that video to learn more. Hit the like button if this helped you, and subscribe to join our movement. Welcome to the Stick Trader Mind. Remember, you are just one trade away. This is a single candlestick. When formed in a specific sequence, it narrates a compelling story of the market's next move. But what if I told you that everything you've learned about candlestick patterns is a fabrication? Hammers, dojis, engulfing candles. None of these cheat codes will yield results unless you pair them with a specific secret technique. Most retail traders treat these patterns like holy grails, clutching their Amazon-bought candlestick mouse pads and blindly entering trades. While these patterns are useful for forecasting, most people utilize them incorrectly. They spot a bullish engulfing candle, think, perfect time to buy, and are immediately blindsided when the price tanks. There is, however, a strategy to know exactly when a collapse is imminent. Every candle you see falls into one of three categories: indecision candles, control shift candles, and strength candles. The power of strength candles. Let's begin with the most influential, the strength candle. These feature large bodies and minimal wicks, indicating that buyers or sellers are in absolute command. But these can get even more potent. If a bullish strength candle prints with a massive body and no upper wick, it signifies extreme momentum. Buyers face zero resistance from sellers. The inverse applies to bearish candles. A large red body with no lower wick proves sellers met no resistance. While rare, these signify total market dominance. Just like most things in life, size matters. A massive strength candle indicates aggressive buying, while a smaller one shows less conviction. Even if a candle is technically a strength candle, its size dictates its reliability. Join the tribe. Access exclusive trade setups in our channel. Link below. Understanding control shifts and indecision. What happens when control abruptly evaporates? That brings us to the control shift or reversal candle. These reveal who is losing the battle and who is seizing the throne. Wicks represent rejected price action. A large upper wick shows buyers tried to push price up but were repelled by sellers. In these candles, the body's color is largely irrelevant. The story is told through the wick. Large lower wicks suggest an upward move, while large upper wicks hint at a decline. When no one is in charge, we see the indecision candle. These have wicks on both sides and tiny bodies, showing equal effort from both sides but no progress. Often called dojis, these typically appear before major breakouts or reversals, as the market hesitates on its next direction. You should never trade based on these alone, but when paired with the next candle, the narrative changes entirely. For instance, if an indecision candle is followed by a control shift, it proves which side won the battle. Real-world execution and broker insights. Before we dive into a live chart example, let me share a discovery. AFX.com. This is no ordinary broker. They offer Forex, stocks, and crypto, a true 3-for-1. The highlight: 0% commissions. Most brokers drain your account with fees that add up to thousands over hundreds of trades. Here, it's free. They are fully regulated and available in 176 countries. Use the link in my description for unlimited 0% commissions. You're welcome. Join our private community for daily analysis. Link in description. Now let's put our three candle types to the test. Imagine a slight downtrend where three indecision candles form. This shows the market is hesitating. Note if a red candle has a large lower wick. This means sellers tried to push lower, but buyers stepped in. When a bullish strength candle prints immediately after, we can expect a sharp upward move. The speed of control and supply/demand. A vital observation. It often takes sellers many candles, for example 22, to drive price down. Yet buyers can erase that entire move in just 4 strength candles. This disparity proves buyers have superior control. We can then mark this origin as our area of demand. As price moves up, it may print a red control shift candle with a large upper wick, followed by a red strength candle. This marks our area of supply, showing sellers are ready to bring the price back down. Now the chart tells a clear story. Buyers moved price up fast, while sellers moved it down slowly. This indicates buyers still maintain the higher order control. Setting the perfect entry as price returns to our area of demand, we look for a green control shift candle. This confirms that sellers tried to break the zone but were repelled. If a green strength candle follows, buyer momentum is confirmed. To enter, we wait for a pullback to that control shift candle. We set our take profit at the area of supply and our stop loss just below the original demand zone. With this setup, there is no guesswork. We have analyzed the areas where control resides. Price hits our target exactly as anticipated because we followed the story, not just a pattern. Conclusion. Read the story, not the cheat code. A final word of caution. Never enter a trade based solely on a single candle. A lone green strength candle is not a strategy. Instead, use these candles like a book telling a story. Look for correlations and identify zones where buyers and sellers exhibit absolute control. Once you find that, you can easily identify where each side is likely to win. Implement this narrative-driven approach, and you will see your take-profit targets being hit significantly more often. Don't trade alone. Join 10,000 plus traders in our free Telegram group, link below. I recently closed out a trade with a massive 10% gain, which provided a significant boost to my overall portfolio. You might wonder, how did I know the chart was destined to move upward? It all came down to identifying this specific candlestick pattern right here. In this video, I'm going to share my absolute favorite candlestick patterns, just like that one, which I utilize on a daily basis. My goal is to help you read and understand chart patterns more effectively, predict market direction accurately, and become a more successful trader capable of making plays just like this. Let's get straight to it. The engulfing candle. One of my most frequently used and highly reliable candlestick patterns is the engulfing candle. I have featured it in many of my previous videos because it is such a potent signal. It can pinpoint the exact moment a reversal is about to occur. So, what exactly is an engulfing candlestick? The name essentially explains the concept. It is a candlestick in the opposite color of the previous one that simply engulfs it entirely. A bullish engulfing candle opens at or lower than the close of the previous candle and then closes above the previous candle's open. Visually, it is larger than the preceding candle on both ends, making it appear as though it is swallowing or engulfing it. Let me show you an example. Here, we identified a very strong support level where the price has bounced multiple times, proving that the market respects this zone. When the price returns to this support, we expect another bounce. However, rather than just assuming the support will hold, we wait for a bit more confirmation. That is when we see a bullish engulfing candle form. It completely engulfs the previous red candle right at the support level. This is an extremely bullish sign, giving us the confidence that the price will move up, so we enter the trade and look at the results. It is important to note that just because you see a bullish or bearish engulfing candle doesn't mean the price will reverse 100% of the time. You should never trade purely based on candlestick patterns alone. Instead, treat them as hints regarding the market's next move rather than absolute decision makers. Use them in conjunction with other tools like support and resistance, technical indicators, and broader strategies. Let's look at a bearish example. Here we have a similar setup, a strong resistance level that price has respected multiple times in the past. As the price approaches this resistance again and starts to decelerate, we see a bearish engulfing candle form, completely swallowing the previous green candle. This rejection at resistance is a great signal to go short, and as expected, the price drops. The momentum candle. Next, we have the momentum candle. This one is much easier to spot than the engulfing candle simply because of its impressive size. A momentum candle is a bar that is 2 to 3 times larger than the candles that came before it. This specific candle can be insanely powerful because in most cases, after it appears, the price will continue to trend in that same direction. This makes the momentum candle a fantastic entry signal. The most efficient and effective way to use this pattern is in choppy markets, where the price is moving sideways. If you ever observe a sideways market and then a massive momentum candle emerges, being 2 to 3 times larger than the previous bars, you can be quite certain the price will continue that way. Why does this happen? Think of it this way. In a sideways market, there are many short sellers stuck in their trades. They don't want to exit yet, because the price is ranging and could still move in either direction. They have their stop losses set right above the resistance. This means there are tons of traders with stop losses clustered in this area. If a sudden price movement hits this liquidation zone, all those stop losses are triggered, adding fuel to the fire and forcing the price to keep moving up. Furthermore, when price breaks out of a choppy range like this, it usually initiates a fresh trend in that direction. The strategy is identical for shorts. If there is a choppy sideways market and a huge red candle appears, 2 to 3 times larger than the previous bars, it is a great indicator to enter a short position, as the price is likely to continue downward. The multiple candlestick pattern. Next, we have the multiple candlestick pattern. This is one of my personal favorites because it tends to hold very true on the charts and is remarkably simple. All it involves is identifying 3 or more consecutive candles that have wicks pointing in a single direction. The more candles you see, the better. I prefer to pair this pattern with support and resistance levels. Look at this chart. What do you see? First, we have a key support level where the price has bounced multiple times. Then, we see multiple candles with downward pointing wicks right at that support. These downward wicks tell us that sellers are trying to break the support, but buyers are fighting them off and winning repeatedly. This confirms the strength of the support and suggests a high probability of an upward bounce. Remember, the more candles you see rejecting the level, the higher the probability that the pattern will be respected. We can apply this to short examples as well. When the price moves up to resistance and you see multiple candles with wicks heading upward, it indicates that the price really doesn't want to break higher. This gives us a solid short entry. We enter here expecting a reversal, and the price drops. The doji candle now. Let's talk about the doji candle. A doji is a candlestick with an extremely thin body and wicks on both sides. It is crucial to understand this candle because it serves as an excellent indicator of an impending price reversal. Essentially, this candle represents market uncertainty. The bulls and bears are in a stalemate and the market is facing resistance in its current trend. Whenever there is uncertainty or resistance, the price will more often than not head in the opposite direction. For example, imagine the price is dropping quite hard. Then, a green candle appears that happens to be a doji. This indicates that sellers are starting to be less confident and buyers are starting to enter, making this a great potential place to enter. What I normally like to do with dojis is wait for one or two follow-up candles of the same color to confirm the reversal. In this case, I see a green doji. I wait to see two more green candles heading upwards, telling me I can be confident that the price will continue in that direction. There are several variations of the doji candle that you might encounter. Regular doji, the classic thin-bodied cross. Long-legged doji, same as the regular one but just has larger wicks. Dragonfly doji, a small body at the top with a large bottom wick. Gravestone doji, a small body at the bottom and has a big upper wick. All of these tell the same exact story, a reversal in price. Hammers and shooting stars. The next candlestick we will examine is the hammer. A hammer typically features a decent-sized body and a long lower wick. This candle tells us that sellers got the price all the way down to here, but the buyers absorbed all that selling pressure and raised the price all the way back up. This is usually an extremely bullish sign and can tell us that the market will continue to go in that direction. Very similar to the hammer is the shooting star. A shooting star is essentially just like the hammer, but with the long wick on the opposite, upper side. You should be playing this just like the hammer, where if you see a shooting star candle like this, you can have a good suspicion that the price will start reversing. The tweezer pattern. The next candlestick pattern is called the tweezer. This pattern consists of a red candlestick followed immediately by a green candlestick, both of which have similar wicks on the bottom. If you see this pair, you can have a pretty good idea this chart is about to move upwards. Let's look at an example. Here we can see price is about to hit this support. We see a red candle with a wick on the bottom right at the support. Then we see a green candle that also has a wick heading downwards. This is telling us that the price is respecting this support and is now getting some momentum upwards. This would be a great time to buy, and look what happens, price raises. The opposite is true for a bearish signal. You want to see a green candlestick, then a red one, both having wicks at the top. We see that exact pattern here, and boom, price falls. The Marubozu. The final candlestick pattern I want to discuss is the Marubozu. A bullish Marubozu is a large green candle that has no wicks at all. It's basically just a big green rectangle. The cool thing about this pattern is that it serves as a good indicator that price will keep heading in the same direction it's going. You will typically see this candle in the middle of a trend, confirming that the trend will keep moving upwards. Let's see an example. Here we saw a price reversal. Price is starting to head upwards. Then we see a bullish Marubozu candle. Notice how the candle has no upper or lower wicks. This means that the lowest price of this candle was the exact same as its opening price, and the highest point of this candle was the exact same as its closing price. This is telling us that buyers have complete control, and we can almost certainly predict that price will continue to go upwards, and look what happens. It does. The bearish Marubozu follows the same idea. It is a red candle with no wicks. Here we see the price had a reversal, then we see a bearish Marubozu candle telling us sellers have control, and the price will probably keep moving downwards. We enter making this a winning trade. Bonus tip. Automatic pattern detection. Now, it's time to give you a bonus tip for all those who made it to the end of the video. This is my way of saying thanks for watching all the way to the end. Even though you should probably try to memorize these patterns so when you see them you can have an idea of what the market is going to do, I completely understand that it's hard sometimes to look for them or remember what they look like. Well, lucky for you, there is a way to make it so you can have your chart tell you exactly where a certain type of candlestick pattern occurs. This makes it really easy for you to spot them, and you don't even necessarily have to memorize them. To do this, just go to TradingView, click the Indicators tab, and type in whatever candlestick pattern you want. For this example, we'll do a bullish engulfing. Simply click it, and TradingView will notify you on the chart when the bullish engulfing candle appears. making it extremely easy to spot when it happens. You can also add multiple candlestick patterns to your chart so you can identify when any of them occur. I hope you guys got some value out of this and you learned something new. If you did, I would really appreciate it if you took 5 seconds out of your day and liked this video. The one and only problem trading with candlestick patterns is false breakouts, where a certain candlestick pattern occurs, but the price actually does the exact opposite of what the pattern predicts. If you want to learn how to avoid situations like this, watch this video where I go over my secret strategy to avoid false breakouts. Thanks for watching, and I'll see you guys next time. Understanding candlestick patterns is one of the most vital components of trading profitably. However, you might be surprised to learn that a vast majority of traders still use them incorrectly. The most challenging aspect of trading these patterns is determining which ones truly yield results, especially since there are so many of them to learn. But here is the honest truth. 99% of these patterns do not actually work. I know this from personal experience because I have rigorously tested almost all of them throughout my trading career. Despite this, I have discovered a small handful of patterns that perform exceptionally well. To this day, these specific patterns have generated a significant amount of profit for me. In this video, I am going to reveal the top 6 candlestick patterns that are proven to be effective, and I will provide everything you need to know about them. As an added bonus, I will reveal how to integrate these patterns with price action to identify high probability trade entries. Furthermore, I have created a free guide that compiles all these high win rate patterns into a single document. Inside, I provide real trade examples along with tips and tricks to boost their success rate. You can use this as a reference whenever you are trading. If you want access to this guide, you can find it inside my free Telegram community. The link is located in the description. Now, let's get into the video. What are candlesticks? First, we must define what candlesticks actually are. Simply put, candlesticks are a visual method for viewing price history. Each individual candlestick represents the price movement of an asset over a specific period of time. For example, if you are viewing a 1-hour time frame, each candle represents 1 hour of price history. If you are on a daily time frame, each candle represents 1 full day. A common question beginners ask is, why shouldn't we just use line charts? Wouldn't that be simpler? The answer is that candlestick charts provide significantly more data about the market compared to a standard line chart. Let's look at an example using the EUR/USD pair. On the left we have a line chart, and on the right a candlestick chart. While they follow the same general shape, the line chart only reveals one piece of information, the closing price for each period. In contrast, the candlestick chart provides 4 distinct data points for that same period. The open, the price at the start of the period, the high, the highest price reached during that time, the low, the lowest price hit during the period, the close, the price at the end of the period. Why this information matters. To see this more clearly, imagine a line chart and a candlestick chart forming simultaneously. The line chart only tracks the close, while the candlestick chart reveals the battle that occurred during that time frame. As traders, this extra information gives us a much deeper understanding of market sentiment, allowing for more informed decisions. For instance, imagine the price hits a support level and bounces. A line chart only shows the bounce. However, a candlestick chart might show a long wick dipping below the support before closing back above it. Image comparing a line chart and a candlestick chart at a support level. This detail tells us that sellers tried to break the level but were rejected by buyers. These nuances are crucial for price action traders because they offer hints about where the market might head next. Anatomy of a candlestick. There are 2 primary types of candlesticks, green and red. A green candle forms when the price closes higher than it opened, indicating that buyers were more aggressive than sellers. A red candle forms when the price closes lower than it opened, showing that sellers held more power. Every candlestick consists of 2 parts, the body and the wick, also known as shadows. The tips of the upper and lower wicks represent the absolute highest and lowest prices reached during that period. The body is slightly different based on the color. Green candle. The bottom of the body is the open, the top is the close. Red candle. The top of the body is the open, the bottom is the close. Interpreting shapes. Body versus wick. On a chart you will notice candles come in various shapes. Some have massive bodies, others have tiny bodies with long wicks. Each shape tells a unique story. Big versus small bodies. A green candle with a large body demonstrates that buyers were dominant. Price opened low and was pushed significantly higher with very little resistance from sellers. Conversely, a red candle with a large body shows seller dominance. The price opened high and was driven down sharply. A candle with a small body indicates a lack of dominance. For example, a small green candle shows that while buyers were in control, sellers put up a strong fight, causing the price to end near where it started. Large wicks. The size of the wick is equally informative. A long wick on the bottom indicates strong buying pressure. This means the price dropped significantly at one point, but buyers were strong enough to push it all the way back up before the candle closed. A long wick on the top indicates the opposite, strong selling pressure. The price surged upward, but sellers rejected that move and forced the price back down. Small body with equal wicks. If a candle has a tiny body and equal wicks on both sides, it signals indecision. Neither buyers nor sellers were in control, and the market is essentially in a stalemate. Pattern number 1. The engulfing pattern. The first of my top 6 patterns is the engulfing pattern. This is a 2-candle setup consisting of a smaller first candle followed by a much larger candle of the opposite color. The key requirement is that the body of the second candle must completely engulf or cover the body of the first candle. Bullish engulfing. A small red candle followed by a large green candle. This often signals an upward reversal. Bearish engulfing. A small green candle followed by a large red candle. This often signals a downward reversal. If price is in a downtrend and a bullish engulfing pattern forms, it indicates that buyers have suddenly become much stronger. Generally, the larger the second candle is, the higher the chance of a successful reversal. To trade this, you can enter a buy position at the close of the large green candle, with a stop loss set at the bottom of its wick. The same logic applies to the bearish version for sell positions. Pattern number 2. The pin bar. The pin bar is a single candle pattern characterized by a very small body and a disproportionately large wick on one side. Bullish pin bar, a small body at the top with a long lower wick. Bearish pin bar, a small body at the bottom with a long upper wick. A bullish pin bar tells us that sellers initially drove the price down, but buyers stepped in with massive force to reject that move. While some traders enter immediately, I prefer to wait for a confirmation candle, another candle in the same direction, before entering. Once confirmed, you can enter after the close and place your stop loss at the end of the pin bar's wick. Pattern number 3, 3-bar continuation. This is a 3-candle sequence used to identify a trend that is likely to keep moving. Candle 1, a large body, bigger than the average candle. Candle 2, a small opposite colored candle, ideally less than half the size of the first candle. Candle 3, another large candle in the original direction that closes beyond the second candle. In an uptrend, this pattern suggests the price will continue to rise. It's a great way to enter if you missed the initial move. You can place your stop loss at the bottom of the second, middle candle. Pattern number 4, 3-bar reversal. This pattern is also a 3-candle sequence, but it signals a change in direction. Candle 1, a large full-bodied candle. Candle 2, a smaller candle of the same color. Candle 3, a large full-bodied candle of the opposite color. The success rate is higher if the third candle's body is equal to or larger than the first candle. If you see a bullish 3-bar reversal during a downtrend, it signals an upward move. You can enter at the close of the third candle and place your stop loss at the low of the second candle. Pattern number 5, breakout candles. This pattern consists of a series of small consolidation candles followed by one massive breakout candle. It shows that the price was stagnant or trapped in a range until one side finally exerted enough pressure to force a sharp move. For a valid setup, you need at least 3 small consolidation candles. The more consolidation candles there are, the more powerful the eventual breakout tends to be. In a bullish breakout, you enter at the close of the large green candle and set your stop loss at the opening price of that same breakout candle. Pattern number 6, shrinking candles. This pattern involves at least 3 consecutive candles of the same color that get progressively smaller, followed by a large candle of the opposite color. This visual sequence suggests that the current trend is losing momentum, the shrinking candles, before a sudden reversal occurs, the large opposite candle. I recommend looking for the 4th candle to close beyond the second candle for better confirmation. For a bullish reversal, you enter at the close of the green candle and place your stop loss below the previous candle's low. The advanced price action strategy. While these patterns are strong, they are most effective when combined with key levels on higher time frames, 1 hour or higher. Patterns on lower time frames are often less reliable due to noise. Step 1. Identify key levels. Look for support and resistance zones or trend lines. For example, if price has reversed twice at a specific level, mark that as support. Step 2. Wait for interaction. Wait for the price to return to that level for a third time. At this point, we expect a bounce, but we don't just guess. Step 3. Seek confirmation. Look for one of our 6 candlestick patterns to form exactly at that key level. If a bullish 3-bar reversal forms right at a support zone, it provides a high confidence entry signal. Example: trading at confluence. Let's look at a confluence level, a point where multiple key levels intersect, such as a horizontal resistance level meeting a descending trend line. These areas are highly likely to cause a price reversal. If the price reaches this confluence and forms a shrinking candle pattern, it confirms that buying pressure is fading exactly where we expected resistance. This provides a perfect short entry. You can place your stop loss above the high of the previous candle and target a 2-to-1 reward to risk ratio. Final resources. If you have stayed through this entire tutorial, it shows you are serious about your trading education. To help you further, I've compiled all these high win rate patterns and 3 additional strategies I didn't have time to cover here into a free PDF guide. You can grab this guide in my free Telegram community, linked in the description. Simply go to the Files section. You'll also get my regular market analysis for Forex and crypto. This is exactly how I would approach learning day trading if I were forced to start over from scratch today. To give you some perspective on my journey, I have been navigating the markets for approximately 3 years now, and in that time I have successfully generated over 6 figures in profits. Before this became my reality, I followed the conventional path. I attended college, focused on the real estate business, and eventually graduated with my diploma. At that point, I was strongly considering a career within the real estate industry, essentially following the typical matrix route that society expects from us. However, one day I decided to take a leap of faith. I chose to go all in on Forex trading, fueled by the conviction that I could earn far more through the markets than I ever could at a traditional 9-to-5 job. With that mindset, why bother spending my life at a real job? I dedicated myself entirely to the craft, studying tirelessly for 6 months to absorb every possible piece of information regarding Forex. Since then, I have transitioned into teaching and mentoring. For quite some time, I've been guiding private students, and it has been incredibly rewarding to see many of them evolve into profitable full-time traders. If I had discovered a step-by-step video like this when I was starting out, I honestly believe I would have mastered the markets 10 times faster than I did. Generally speaking, there are 3 critical phases to becoming a trader: the learning phase, the testing phase, and finally the execution phase. Phase 1, the learning phase. The first step is to learn from a single expert. There is absolutely no reason to try and reinvent the wheel or struggle to develop a unique trading strategy from thin air. If a specific method has consistently worked for someone else, there's a very high probability it will work for you as well. This is why I strongly advocate for finding a mentor. The ultimate shortcut to success is to follow in the footsteps of someone who is already achieving the results you desire, someone who truly understands market dynamics, and then work to emulate their thought process. Admittedly, the internet is overflowing with free information, particularly on YouTube, but this abundance can be a double-edged sword. It is easy to become overwhelmed by the thousands of different strategies available. Everything feels messy and disorganized, leaving you unsure of where to even begin. I personally release new high-value trading videos every week for free, and while many other creators are doing the same, the secret is to find one specific educator whose style resonates with you. Watch every single video they have and ignore the rest of the noise. I recommend setting aside one specific day each week, Saturday for example, and dedicating that entire block of time solely to your education. I would spend that Saturday consuming YouTube tutorials, progressing through online courses, and reading free trading books to get my hands on every available insight. Remember, no matter how skilled you become, you must never stop learning. Even today, despite my success, I am constantly studying advanced strategies and reading books on trading psychology to further sharpen my edge. The second step within this phase is to join a community. You have likely heard the cliche that you are the average of the 5 people you spend the most time with, and I can confirm that this is undeniably true. I have noticed that the people I keep closest to me are all incredibly driven and goal-oriented. They know exactly what they want out of life. To become a successful trader, you must surround yourself with people on that same path. I created a Discord server called the Trading Tribe, specifically for this purpose. It is a free space where you can connect with like-minded individuals who share your hunger for growth. Every member of the tribe is either already successful or working remarkably hard to get there. You can share your chart setups, ask technical questions, and observe other people's strategies to see what is proving effective for them. There are countless helpful people in that server who would be happy to support your journey, so if you want to join us, click the link in the description. Phase 2. The testing phase. The second phase of the journey is the testing phase. It is vital that you trade on a demo account before you ever touch a live environment. You should strictly avoid live trading until you have proven yourself to be consistently profitable with paper money. Do not attempt to rush this process. When I was a beginner, I was exactly like many of you. I despised my job, I was tired of being broke, and I wanted to quit as soon as humanly possible. Because of that desperation, I only spent 1 month on a demo account before jumping into the deep end. I opened a live account, deposited $500, and proceeded to blow the entire balance in just 2 days. If I could start over, I would spend significantly more time refining my skills in a risk-free environment. Here is the real secret to successful demo trading. You must treat that virtual balance as if it were your own hard-earned cash. Try to trade with the same position sizes you would use in real life, and convince yourself that the stakes are real. This allows you to experience the same emotional highs and lows as you would in a live trade, which is essential practice. Please remember, guys, you should only transition to a live account once you have found a winning strategy, performed extensive backtesting and front testing, and mastered your emotional control and risk management. Only when you are consistently profitable on demo should you move forward. Many new traders skip this and end up losing money they didn't have to lose. The unfiltered truth for beginners. Now I want to offer some raw, unfiltered advice for those who want to learn this fast. If there were a to-do list for beginners, step 1 would ironically be to lose money. It is almost a mathematical certainty that as a novice, you will face losses. Knowing this, you should save your capital and practice until your confidence is backed by data. When you eventually do go live, start small, because that initial capital will likely vanish quickly as you learn. Many of you have seen trading gurus flaunting mansions, supercars, and a glamorous lifestyle. You might watch 3 videos and expect to become a millionaire by next week, but that isn't how reality works. Like any other profession, trading takes time to master, but the payoff is worth every second of the grind. In the beginning, your focus shouldn't be on profits at all. Instead, your focus should be on learning, finding a strategy that fits your personality, testing it, and improving your discipline. I promise you that the profits will eventually arrive as a natural byproduct of your growth as a trader. Put in the work now, and the market will reward you later. Phase 3, the execution phase. The final phase is the execution phase. This is the point where you take your successful, proven strategy and apply it to a live trading account with discipline. If you are looking for a place to start, you can check out the video linked here where I break down my own personal trading strategy, one that has been thoroughly backtested and proven to work. Click on that video to learn the specifics, and if you gained any value from this discussion, please hit the like button and subscribe to become a permanent part of our tribe and our movement. Welcome to the team, and never forget, you are truly just one trade away from a different life. You are likely watching this video because you've recently suffered a significant financial loss in the cryptocurrency or Forex markets. No matter who you are, I am here to assist you with the psychological aspects of trading and the specific mindset required to succeed as a day trader. A successful market participant is, above all, highly organized. Therefore, in this video, I'm going to provide you with 5 non-negotiable rules that you must follow to become an elite trader, improve your psychological resilience, and maintain a sense of calm during the heat of battle. Welcome back to the channel, where we discuss everything related to day trading to help you maintain consistent profitability. Now, let's be honest. Most people don't type trading psychology into a search bar unless they've just lost a substantial amount of money. First, let me say that I am genuinely sorry you lost money. However, secondly, let me tell you that I have walked in your shoes. I have done the exact same thing, and I am here to help you fix it. The emotional trap and the snowball effect. Here is what you are likely doing. You enter the markets, you stare at the price action, and you see a sudden surge. Without any technical analysis aside from the fact that the price is skyrocketing, you jump into a trade. You tell yourself you'll just scalp a quick profit and get out as fast as possible. You see a small gain, but you don't take it because you're convinced it will go even higher. Then the market reverses. You panic and tell yourself, no, it will come back to where it was and then I'll take my profit. But the price keeps dropping. It goes down and down and you change your tune too. I'll just wait until it hits my